Hello number curious friends, welcome to the channel where we talk accounting and finance. Today we make sense of loans and borrowings. You will learn what they are, how to record them at the start, how interest really works with the effective interest method, what to do with fees and simple journal entries. What counts as a borrowing? I will already start with the reference to our previous video where we discussed the very basics of the loans. The link to it you can see now in the top right corner, check it out. So, a borrowing is money you owe to a lender under a contract. Examples include bank loans, bonds, notes payable, overdrafts, shareholder loans, and so on. With a borrowing, you owe money to someone. That means it is your liability, and that's why it is recorded on the balance sheet in liabilities. For example, like this. If the borrowings are due within 12 months, they are current. If due later, they are non-current. Let's imagine we want to increase our inventory of apples in our apple shop, but we don't have enough money. We talk to our bank and they approve us a loan, $1,000 for 5 years, with the repayment in the end of the term. This amount is called a principal amount, the total nominal amount of the loan we need to repay. When we receive a loan, a very simple double journal entry for it will be: debit, cash 1,000, is been wired by the bank into our current account. Credit, loan payable 1,000, recorded in the liabilities. Borrowings are not for free, they cost money. This cost is reflected as an interest and can be defined in various ways. These typically include simple fixed interest, compound interest, fixed rate interest, and variable rate interest. There are some other more complicated types like payment in kind, PIK, or zero coupon, but we won't discuss them today. Interest is normally calculated in the books on a monthly basis for simplification. However, daily accrual is also possible. Interest can then be paid monthly, quarterly, every 6 months, annually, or even in the end of the loan period. And now, before we move on, if you find our lessons useful, please take a moment to hit a like button, subscribe to our channel, or leave a comment. This is very important for the channel, and thank you for being with us, this means a lot. So, the easiest interest is a simple fixed interest. It is fixed as a certain percentage and applied to the original amount of the loan, an initial principal amount. In our case, let's say we've got a loan at 5% per year. By the way, very often it will be called per annum and abbreviated as PA. So, in the case of a 5% interest rate, we will pay 5% on 1,000 or $50 per year. This will be accrued monthly as 1/12 of the total, or $4.2 per month. In 5 years, we will pay $50 times 5 equals $250 of interest on a $1,000 loan. Another type of interest is a compound interest. The interest rate is fixed again, let's say 12% per year, but the interest payment is calculated on the principal plus accumulated interest from previous period, as an interest on interest. Here, compounding period is important. That means how often you calculate the compounding part. It can be monthly, quarterly, every 6 months, annually. If it's monthly, then after month 1, we will have 1,000 of principal plus $10 of monthly interest. It is calculated as 1,000 times 12% divided by 12 months. It will be $1,010 in total. For the next months, the interest will be calculated on 1,010, not 1,000, and will be now 1,010 multiplied by 10% divided by 12, and equals $10.01. It may appear small, but every month it adds up. Look at this graph, a comparison between 12% simple and compound interest with the monthly compound period on a 1,000 loan over 5 years. Then the interest can be fixed or variable rate based. Fixed rate is exactly what it says. It is fixed for the full term of a loan. Variable rate changes. For example, the contract can say it increases or decreases every year. However, the most typical variable rates are those based on variable component tied to the interest rates of central banks or markets, which are called risk-free rates, plus a fixed top-up. The most common reference market rates are Euribor, Euro Interbank Offered Rate, SONIA, Sterling Overnight Index Average, SOFR, Secured Overnight Financing Rate in the US. It may look like this in the contract. 12 months Euribor plus 1.25%. If Euribor is 2%, then the interest rate is 2 plus 1.25 equal 3.25. If after 12 months Euribor increases to 4%, the interest rate will become 5.25%. Let's now look at accounting in detail. We have already received cash of $1,000 and recorded a loan payable. Now, every month we will calculate interest. If we don't pay it monthly, we accumulate it on a monthly basis. Debit interest expense 4.2, expense goes into P&L, credit loan payable 4.2. We increase amount of the loan to $1,004. And we repeat this accrual until we actually pay the interest. If we pay the interest annually, then in month 12 we will have $50 accrued, 4.2 times 12, and the total loan payable will be $1,050. The payment will be recorded as follows. Debit loan payable 50, we reduce the loan back to 1,000 principal. Credit cash 50, we pay in cash. These are two key entries, accrual of interest and payment of interest. Now, when repaying the loan, we record debit loan payable 1,000, we completely remove it from the liabilities. Credit cash 1,000. If we repay loan early, there can be early repayment fees, also called break fees. They can be calculated differently, but the amount of these fees is then recorded as an expense during repayment of the loan. Debit break fees expense 100 in the P&L, credit cash 100. If your loan is in foreign currency, you will need to remeasure the amount at the closing exchange rate at each reporting date. The difference is a forex gain or loss in the P&L. Interest is calculated based on the original principal and then translated. Journal entry would be debit forex loss 20, credit loan payable. We increase the amount of what we need to pay in our currency. If we have a gain, then the entry will be opposite. Debit loan payable 20, we decrease the amount we need to pay. Credit forex gain 20 in the P&L. Now let's have a look at another situation. Often, to get a loan, you will need to pay an arrangement fee to the bank or another third party. It can also be called a transaction or origination fee. Under both IFRS and US GAAP, you cannot directly expense these fees. You are required to capitalize them. The argument for these is that this cost relates to the whole period of the loan, not to a point in time, and is amortized over the term of the loan. This capitalization will result in a decrease in the amount of the loan, which is recorded on the balance sheet. It may sound confusing, so let's have a look how it works. Back to our $1,000 loan. When we got it, we recorded debit cash 1,000, credit loan payable 1,000. Now, let's imagine the bank charges $50 for it. That means we now need to transfer these $50 to the bank. But instead of expensing in P&L, we will record this payment against the loan payable. It's a debit journal entry, as for an expense. Debit loan payable 50, credit cash 50. This debit to loan will reduce our liability on the balance sheet to $950. And as we have paid 50 in cash, our cash will also reduce by 50 to $950. So we still have a balance in balance sheet, $950 in cash and $950 in liabilities. You will sometimes see this decrease in the liabilities called disagio. But you will still have to repay the full amount you have borrowed, $1,000, in 5 years. So, every year you will amortize the capitalized cost of 50 to get the total liability back to 1,000. This is called an effective interest method. This method spreads the cost of borrowing over time so that interest expense reflects the true economic rate, how much the loan actually costs you. To calculate effective interest rate, you take all payments for the loan over 5 years and divide it by a carrying amount on the balance sheet of $950 and 5 years. To calculate interest expense, you start with the reported amount of the loan after fees and multiply by the effective rate to get interest expense for the period. Actual cash payment for the interest will be now different to the expense, as you have already paid $50 on day 1. Let's have a look at an example. The flow is as follows. Opening carrying amount of the loan multiplied by effective interest rate equals interest expense. Interest expense minus cash paid equals change in carrying amount of the loan on the balance sheet. Now with the numbers. We have $1,000 loan, and over 5 years and 5% interest rate we will pay 1,000 times 5% times 5 years equals $250 of interest. We also have paid a fee of $50. Total payments for the loan are 50 plus 250 equals 300. On the balance sheet, carrying amount of the loan is 950. To calculate an effective interest rate, we divide 300 by 950 by 5 years and get 6.3%. So our effective interest rate is 6.3%. In year 1, our effective interest rate expense is 950 times 6.3% equals $60. So we record the following journal entry. Debit interest expense 60, credit loan payable 60. We increase the loan payable by $60. Remember, while we owe bank $1,000, on the balance sheet our liability was $950, as we reduced it by $50 of capitalized fees. That means our new reported liability is $950 plus 60 equals $1,010. Now we actually pay the interest, and the actual payment is $50. Debit loan payable 50, credit cash 50. With this journal entry, we reduce the loan liability from 1,010 to 960. So you see, the difference between effective interest rate of 60 and an actual payment of 50 is 10, and it is added to the loan payable. If we repeat the cycle for 5 years, we will have 5 times 60 effective interest expense, 5 times 50 of actual cash payment, and 5 times 10 equals 50 increase in the loan liability. So, by the end of the year 5, our loan liability will increase from 950 to 1,000, exactly the amount we need to repay. So, in the end, this complicated accounting will capture that we have paid $50 in fees, $250 in actual cash interest payments, which together are $300, and finally pay back $1,000 of a loan to the bank. Not easy, right? But this is a very important topic in accounting, so take time to understand it. And if anything is still not clear, just ask in the comments to the video. And yet another interesting complication: borrowing costs on qualifying assets, but we will keep it simple for now. When you build some qualifying asset that takes time to get ready, for example a production facility, and you borrow money for this construction, borrowing costs directly attributable to this asset can be capitalized as part of the cost of this asset while you build. When the asset is ready for use, you stop capitalizing and expense interest going forward. And with this, let's wrap it up for today and continue in the next video, where we'll have a look at covenants, KPIs, common mistakes, and a few examples from real-life financial statements. If you have questions, post them in the comments below. Thank you for watching. If you enjoyed this lesson, hit like, subscribe, and ring the bell so that you don't miss the next video. See you soon, and keep those debits equal to your credits.